Welcome to the Level 1 Portfolio Management Summary video series. This video is a summary of the reading on Portfolio Risk and Return Part 1 and Part 2. The first part of the reading has to do with various return measures, and I'm not going to go over the detail because you've seen this in quant. Return can come as income or as capital gains, you know that. Holding period return is the return over a particular period. You have learned how to calculate arithmetic. Arithmetic means, when do you do this? If you have three stocks A, B and C, and last year the return was 20% here, 10% here, 5% here, your mean return is based on arithmetic mean. What about geometric mean? This is based on time. So if your returns over the last 3 years were 20%, 10% and 5%, then how do you come up with the geometric mean? 1.2 into 1.1 into 1.05 raised to the power of 1 over 3. The money weighted return is simply the IRR. There is a somewhat complicated example in the curriculum where you have to figure out the actual cash flows and then plug those cash flows into the calculator and compute the IRR. You might have different investments that are giving you different holding period returns. To compare them, you need to annualize. So make sure that the returns are stated on an annual basis before you compare different investments. Portfolio return, this would be the weighted average of the returns of the instruments in the portfolio. Other measures of return. Gross return is the return earned by an asset manager prior to deducting management fees and taxes. If you want to compare 5 different investment managers and you want to see who's the best, then you should look at the gross return. Net return accounts for all managerial and administrative expenses. That is what the investor ultimately is concerned with. So ultimately that's what you get. Pre-tax nominal return is the return before accounting for inflation and taxes. So if a fund says that they have a 12% return and don't say anything else, the default is that this is a nominal return and this is pre-tax, because obviously the fund doesn't know what your individual tax bracket is. After tax nominal return is the return after accounting for taxes. Obviously real return is the return after accounting for taxes and inflation. Leveraged return is where you borrow money and invest. This is covered in detail in equity, but generally when returns are positive, then leveraged returns are larger than non-leveraged returns. But the risk is, if the market goes down or the investment goes down, then the losses are also leveraged or magnified. Next we talk about risk, and the measure of risk that we'll use here is variance or standard deviation. So standard deviation is simply the square root. We've seen this in quant, and rather than repeat the formula, I'm just repeating the keystrokes for the calculator. So make sure you can do this. On this slide I've put together a lot of related information. So covariance is a measure of how two variables move together. The values range from -infinity to positive infinity. The formula for covariance was discussed in quant, so that's not being covered here. Correlation is a standardized measure of the linear relationship between two variables. So since the correlation is between -1 and 1, a number makes sense. So if you know that the correlation is 0.9, that means it's very high. If you know that the covariance is 72, you don't know whether that is high or not. You know it's positive, but how strongly correlated, you don't know. These are the formulas that you do need to know. These connect correlation and covariance. So remember the fact that the correlation between two securities is the covariance between those divided by the standard deviation of the first and the standard deviation of the second. If you have a portfolio of two assets, then the expected return is simply the weighted average of the returns of the two instruments. So you have instrument 1 and 2. This is the expected return of the portfolio. And then this is an extremely important formula that you've seen in quant and that you are seeing here. This is the variance of the portfolio, which depends on the weightages, the individual standard deviations and the correlation. This is the variance, and obviously to find the standard deviation you take the square root. Now plotted over here is risk on the x-axis, return on the portfolio on the y-axis. Let's say that you put all your money in asset 1 Say that's represented by this point. So this is 100% weightage in 1. Then as you move over here, we are saying that you are reducing the weightage in 1 and adding 2. And assuming that the correlation is say 0.5, which is less than 1, then you will get a diversification benefit because you are reducing risk and increasing return. You get to a point which is the minimum possible risk, and then after that, as you keep increasing the weight of 2, you will have more risk and more return. If the correlation were lower, say the correlation was 0, then you would have even more diversification benefit. If the correlation were the theoretical minimum of 0.1, then it would be possible to construct a portfolio with 0 risk. Utility theory and indifference curves. Here is a formula that you must remember. The utility of an investment is the expected return expressed in decimal minus half times what is called the risk aversion coefficient. So this would be a number like 2 or 3 or something. The more risk averse, the higher this number. And notice the minus sign. So the minus means that as A goes up, the utility comes down. So also sigma squared is the risk or the variance of the investment. So make sure you know this. Make sure that all the numbers that you put in are in decimal. So if you have an investor with a risk aversion of 2, he owns a risk-free asset returning 5%. What is his utility? Answer 0.05 because you simply put in 0.05, 5% return in decimal. You know that the risk is 0, so don't do any further calculation. Now, so let's say that he's over here, this is 0.05. He is considering an asset with a risk of 10%. At what level of return will he have the same utility? The first high-level question is that if the risk is 10%, will the return such that he has the same utility be here point A, point B or point C? So that's A, B, C. It would have to be A because to be equally happy when he's taking risk, he needs to get a higher return. So you can see that the indifference curve will be something like that. But what is that level of return for him to have equal utility? You do a simple calculation. We've established that the utility needs to be 0.05. The return R is not known. Minus 0.5 is simply coming from the formula. A is given. And 0.01 is the decimal form of, actually this should be, yeah, it's 10% is 0.1, but it's squared. So 0.1 squared is 0.01. So that's where 0.01 is coming from. So 0.06. What that is saying is at a return of 0.06, he is just as happy as he was with a risk-free investment giving 0.05 or 5%. Then given a choice between a risk-free asset and a stock with an expected return of 10% and sigma equal to 20, so this is 20%, what will he prefer? So how do we do this? We already know the utility of the risk-free asset. So now we need to figure out the utility of this investment. What's the utility? It is 0.1, which is the expected return, plus 0.5 into 2 into 0.04. Where is this coming from? It's 0.2 squared, 0.06. This number is higher. So he will prefer the stock to the risk-free investment. Higher utility means that he is happier with this investment. Investment opportunity set and minimum variance frontier. Consider the universe of risky investable assets. These can be combined to create many portfolios. This set of portfolios is called the investment opportunity set. What you need to know is if you have expected return of portfolios on the y-axis, the risk on the x-axis, if you take any level of return, you will find several possible portfolio risks, but there will be some portfolio with the lowest possible risk at this level of return, given that you only have risky assets. So if you plot something like this, you will create a curve that looks like this, which is saying that at any level of return, there will be some portfolio that has the lowest possible risk. Then there will be other portfolios with more risk. But this frontier, which is called the minimum variance frontier, shows you the minimum variance at each level of risk. So what's this overall curve called? It's called the minimum variance frontier. This point over here represents the global minimum variance portfolio, because if you combine only risky assets, this gives you the lowest variance. The part of the minimum variance frontier that is above the minimum point is called the efficient frontier. Clearly the efficient frontier dominates the lower part, because at any given level of risk you want the highest return. CAL and CML. The addition of a risk-free asset makes the investment opportunity set much richer than what we just saw. So this, for example, is a segment of the efficient frontier, but the limitation with the efficient frontier was that we were only working with risky assets. Now if we also add the risk-free asset, what we can do is take a line that connects the risk-free to this point over here. If you talk about this line, if this line is, let's say, the capital allocation line, then what we are saying is for a particular investor, this is the efficient frontier. This then is called the optimal risky portfolio. The line connecting the risk-free asset to the optimal risky portfolio is called the capital allocation line. And this line represents different weightages of the risk-free asset and P. If you assume that all investors have the same expectations about the market, which means the same expectations related to return, risk, variance, etc., then everyone will have the same efficient frontier and everyone will have the same CAL. That similar CAL is called the CML. So the CML is a special case of the CAL. It is what happens when all investors have the same expectations. When this is the CAL, then that efficient portfolio is called the market portfolio. Theoretically, the market portfolio includes all risky assets or anything that has value, but not all assets are tradable and not all tradable assets are investable. Practically, we use a major stock market index such as the S&P 500 in the United States as a proxy for the market. Optimal investment portfolio. So the point is, we've talked about the CML. So let's say this is our CML. You need to figure out where on the CML your client, a particular investor, needs to be. So to do that, you need to understand the utility curves or the indifference curves of your client. Say you have a client called red client who is very risk averse. If he's very risk averse, then he'll have very steep indifference curves. So for this client, red client, this is the optimal portfolio, because obviously your client will be happier the more top left we go. The utility is higher on this third curve. So you have to be on the CML, because CML is the frontier of what is possible. Obviously the client will be happier over here, but there is no portfolio that we can find. So this is the optimal risky portfolio for your red client. Now let's say you also have a blue client who is less risk averse. If he's less risk averse, then the slope will be less. So for this blue client, this would be his optimal risky portfolio. Next we come to leveraged portfolios. Say this is the market portfolio from before. This part marked in red represents a combination of investing in the risk-free asset and investing in the market. Investing in the risk-free asset means that you are lending to the government. Points beyond this, the dashed part, are called borrowing portfolios, because here you need to borrow at the risk-free rate and take that borrowed money and invest it in the market. You also need to know the equation for this CML line, and that equation is given right here. The y-intercept is the risk-free rate. The slope is the change in y over change in x. So what does this point represent? It's the risk of your market. So that's x. And what is this? It is the return on the market minus the risk-free rate. So that's the slope shown here, and the slope is also the Sharpe ratio, and then the x is sigma p. The other scenario, which is more practical, is that the borrowing rate is higher than the lending rate, because typically when you lend to the government, then let's say you get the risk-free rate of 10%, but when you borrow, normally you would borrow at a higher rate. Then you have a kink in this curve. This part of the curve has the same equation, but the other part of the curve, that equation is shown right here. The only difference between these two equations is that here, instead of saying the risk-free, we use RB, and since RB is higher than the risk-free rate, the slope becomes less. The logical explanation to this is, since you are borrowing at a higher rate, the extra return you get per unit of risk is lower. Alright, moving on. Pricing of risk and computation of expected return. Very broadly speaking, you either have systematic risk or non-systematic risk, and the high-level summary point that you must know is that you only get compensated for the systematic risk. The systematic risk is also called beta risk. Another way of putting it is that this is what is priced. Priced risk means that when you take that risk, you can expect a return. If the risk is not priced, then when you take that non-priced risk, you do not get a return. For high returns, you need to take risk, that's true. But does all risk lead to high returns? No. Only systematic risk leads to high returns. Total risk is measured by total variance. This is a combination of systematic and non-systematic variance. There is no compensation for non-systematic risk. It is local. And the reason there is no compensation for non-systematic risk is because it can be diversified away. Investors only get a return for systematic risk. It is the risk that impacts the entire economy and cannot be diversified away. Pricing of risk. Pricing an asset is equivalent to estimating its expected rate of return. Price and return are therefore often used interchangeably. Beta is a measure of systematic risk. It tells us how sensitive an asset's return is to the market as a whole. So what is the formula for beta? I've given it in words because this is easier to remember. Beta is the covariance of the return on that asset with the market divided by the variance of the market. In symbols, you will see it written like this. So covariance of a given stock I with the market divided by the variance of the market. So you can remember either this symbolic form or the English form, but remember at least one of these. The capital asset pricing model, extremely important. So this is CAPM. We saw this earlier in corporate finance. We'll see this later in equity. So as I keep saying, you have to know this. You also need to know the various assumptions of CAPM. And then you need to know that the security market line, which has beta on the x-axis, expected return on the y-axis, is a graphical representation of CAPM. The SML can also help with security selection, because SML is telling you that at a given level of beta, say if beta is equal to 1, then your required return might be 10%. If there is a stock with a beta of 1 and where you expect a return of 12%, this is good. This security that's over here is underpriced or undervalued. So over here, you buy the undervalued. Anything that is over the SML is undervalued. Anything that is under the SML is overpriced or overvalued. There might be questions comparing SML and CML. Note that the y-axis is the same for both, but on the x-axis we have systematic risk with SML. So the easy way to remember, S for SML, S for systematic risk, and CML has non-systematic risk on the x-axis. In terms of the slope, for the CML, the slope is the Sharpe ratio, whereas for the SML, the slope is the market risk premium. All right. The CML applies to efficient portfolios. Remember, when we came up with the CML, we had the efficient portfolio and it uses total risk. SML applies to any security and uses systematic risk. So those are the major differences. Performance evaluation. This whole concept that we've discussed can be used to evaluate the performance of a portfolio manager. So one measure is the Sharpe ratio, which shows the excess return per unit of overall risk. Commonly used measure, but it has two limitations. It uses total risk and not systematic risk. Second, a ratio of say 0.7 doesn't tell you much. It has to be compared with another ratio to determine whether it is better or worse. The fact that this uses total risk can be improved by using the Traynor ratio, which is like Sharpe except that it uses systematic risk. But the issue related to ratio still remains. The other issue here was that it uses that this is a ratio. So here is another measure called the M squared measure, which gives you a number, and you need to remember this formula. It's the return on portfolio minus risk-free into standard deviation of market over standard deviation of portfolio minus the market risk premium. So this gives you a number that has meaning. A number of 0 will mean that you are not adding value. You are getting the same risk return characteristics as the market. A positive number means that you are doing well. Negative number means that you are doing badly. But the limitation is that it uses total risk. The most theoretically appealing measure is Jensen's alpha, which is the return on the portfolio minus the return that you would require given the systematic risk. And notice that in these blocked brackets is CAPM. So in through CAPM you get what you require. This is what you are expecting. So if this number is 2%, that means that the Jensen's alpha is 2%, which is a good thing. A positive number would be a good thing. Constructing a portfolio. Theoretically, investors should hold a combination of the risk-free asset and the market portfolio, but it is impractical to own the whole market. It can be shown that holding as few as 30 stocks can diversify away the non-systematic risk. So if you just own one stock, your risk might be up there. When you own 2 stocks, you come down here. It can be shown that as you keep adding more stocks, this is number of stocks on the x-axis and variance over here, and this is the variance of the market. So it can be shown that when you come to about 25 to 30 stocks, you are almost sufficiently diversified. So once you come over here, then you are more or less down to the variance of the market. So you have diversified away all the non-systematic risk. After that, as you keep adding more stocks, your risk is lower, but only marginally lower. You can never come below market risk simply by adding more stocks. If you found this lecture helpful, then I'll be very grateful if you can do 3 things for me. Number 1, like this video. Number 2, like my Facebook page. And number 3, visit analystforum.com and there add my logo to your studying with profile. You can see this slide for help on how to do that. Thank you very much and good luck with your studies.